Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts. It's Monday, March 30th, 2026, and the vibe was cautious. On the surface, the S&P 500 looked almost fine, but underneath, traders were actively cutting high beta risk. Defensives quietly held the index together, while semiconductors cratered and small caps took the real damage. On the S&P 500 Heatmap, the color story was uneven. Steady greens in defensives, healthcare, staples, utilities, and some support in financials. But the red was loud and concentrated, especially in semiconductors and chip equipment, and mega-cap tech wasn't unified. A few big platform names stayed green, while the chip-heavy pockets dragged hard. That's how the index looked healthier than the internals really were. That heat map lined up with the money flow. Capital rotated out of high-duration, high-beta trades, semis, AI hardware and levered growth proxies, and into defensives and steady cash flow names. Financials held up too, with payments showing strength. The big tell was the divergence, Nasdaq weakness, and an even bigger hit to the Russell. That reads like traders shrinking volatility exposure, not chasing broad upside. So the backdrop today was a nervous standoff. The selling didn't feel like panic, more like controlled, methodical offers. And the key psychological piece? No catharsis. Semis got hit, but the broader market never fully flushed. It rotated away. That can keep pressure on because without a clean washout, chip bounces can keep turning into sell-the-rip moves until a real catalyst changes the narrative. On the rumor and chatter front, there wasn't one clean headline driving the tape. What circulated was more story than news, talk about sell the news and cycle peak fears in memory and semis. But that's not confirmed information. The cleaner read from today's action, positioning and rotation pressure centered in chips and high beta. Micron, MU, was the day's pressure point. The stock dropped about 9.7%, a sharp continuation move in memory. Traders framed MU as the risk barometer. Once it broke hard, the whole chip stack traded like a degrossing event, with sympathy selling spilling into equipment and adjacent AI hardware exposure. Nvidia, NVDA, was another key tell. It finished down about 1.5% in the broader semiconductor weakness. The read was simple. Nvidia is the AI tape's gravity well. When Nvidia prints red on a day like this, dip buyers stay cautious, and it gets harder for tech to stage a clean rebound. Lam Research, LRCX, put an exclamation point on the equipment side, down about 5.4%, sold off in sympathy with memory, and the broader chip unwind. The message was straightforward: equipment is Capex confidence. When LRCX gets hit like that, traders read it as the market questioning the durability or the timing of the next spend leg. Meta, META, was one of the names that helped mask the damage. It was up about 2.1%, one of the green generals. That strength mattered because it kept the tape from feeling like a full tech unwind, even while semis and high beta hardware were getting repriced. Caterpillar CAT showed this wasn't just a chip story. CAT fell about 4% as machinery and cyclicals got cut. The read framed Caterpillar as a macro and cycle proxy, so a move like that sounds like skepticism on forward growth and global demand. Very consistent with a defensive rotation day. On the other side of the ledger, PepsiCo PEP was up about 2.5%. Classic Staples leadership. The takeaway was simple. When Staples are leading on a tape like this, it's confirmation that the market's hiding instability in cash flows, while higher beta areas get cut. Looking ahead, the next big U.S. macro catalyst window kicks off the week of April 6th, ISM services on Monday, durable goods on Tuesday, FOMC minutes Wednesday, then core PCE, final GDP, and jobless claims on Thursday, and CPI with University of Michigan sentiment and inflation expectations on Friday. Positioning-wise, the key question now is simple. Can semis stabilize after the shock, or does follow-through selling keep the risk-off rotation in control? And just as important, do defensives keep outperforming, or does leadership broaden back out? Bottom line, the index looked calm, but the internals were loud. Defensives led semis and small caps were the damage zone, and a handful of mega-cap platforms kept the headline numbers from really breaking down. Next session, it's all about breadth. Does the market keep shrinking toward safety, or do chip bounces finally start to stick? Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.